Je suis enchanté.
So let's continue our look at bonds by looking at a few alternative types of bonds that are out there. Because bonds are ultimately simply a contract between a borrower and a lender, actually usually a borrower and many lenders, they can be customized and tailored in a whole variety of ways. This little list here is a small portion of the different kinds of arrangements that can be made, but these are maybe more common than others out there and things that I want you to be familiar with. So the first one is inverse floaters. These are similar to floating rate bonds, except that they move in the opposite direction. So in this case, the coupon rate, instead of falling when market interest rates fall, instead of changing with the market conditions in the same direction, it changes with market conditions but in the opposite direction. So coupon rates will fall when market interest rates rise on inverse floaters. Asset-backed bonds are another type of bond, another alternative. This is where the income from a specified group of assets service the debt on those bonds. Very common with mortgages, mortgage-backed securities. So whenever homeowners make the payments on their home loans, those cash flows go to the owners of the bonds, and those payments by the homeowners service the debt. Could be the same instance with car loans. There are also asset-backed bonds that use income from royalties to service the debt associated with those bonds. So anything that has a group of assets that are generating income, generating cash flows that service the debt. A payment-in-kind bond or a PIK bond is an instance where borrowers can choose to pay interest with cash or with more bonds. So these are maybe more common with companies that have some cash constraints, perhaps younger companies or companies that are in a rapid growth phase. These have maybe less protections for lenders. If you don't get cash when you want to, but you're getting another promise, another IOU, may not be quite the same thing. But with bonds that have these kind of provisions, the lenders know going in that they may not be getting cash flows when they expect them. So paying kind bonds are going to be riskier. Everything else being equal, should have a higher interest rate because of the risk that you're not going to get cash. You're going to get more promises. Catastrophe bonds or CAT bonds, these are bonds where payments are tied to the absence of a disaster typically. It's a way particularly for insurance companies to transfer risk. And an example might be if there is no Category 4 hurricane that messes up Florida, you'll be paid on your catastrophe bond. If there is a big hurricane that hits Florida and there are significant losses for the insurer, some of that loss gets passed on to the owners of these catastrophe bonds. They may forfeit all the principal that they lent, or they may only get a portion back. But the main idea is it's a way to transfer risk between parties. Index bonds are another very common bond, particularly Treasury inflation protection securities. These are U.S. government bonds that are indexed to inflation. So as inflation goes up, the interest payments and the principal outstanding go up on the bonds as well. And so investors are protected from changes in the price levels, changes in inflation. Other types of bonds tied to maturity are ultra-long bonds and perpetual bonds. Ultra-long bonds are bonds with anywhere from 40 to 100 years to maturity. These have been showing up in recent years with more regularity. Some Asian countries have been issuing very long-term bonds. And then obviously perpetual bonds would be bonds with no stated maturity. They can go on theoretically forever. Typically though, those are refunded after long periods of time. Mini bonds are another type of bond that have become more common in recent years. These are lightly regulated. They're loans between investors and a company, usually with some kind of a sweetener for the lender. So for instance, a burrito restaurant chain might issue these mini bonds where, as part of you lending them money, they give you the opportunity to get a free burrito each week as part of your repayment. Now, because these are lightly regulated, those sweeteners may or may not last. If the burrito restaurant becomes constrained and people are eating them out of House and Home by taking those free burritos. They may change those terms, but anyway, these are loans that have they're kind of unique, have a little bit of twist. They aren't registered securities typically. They're kind of like the crowdsourced financing where I give $1,000 to my local pub and I get to have a free adult beverage every time I go in, something like that. So it's more of a crowdsourcing versus a big industrial scale type of loan. And then another alternative kind of bond out there that has got some notoriety in recent years are equity-linked structured products. These are typically issued by investment banks, and they're tied to a company's stock. And so what will happen is, for instance, if it's tied to Apple, and there have been hundreds of these structured products linked to the stock of Apple, if the stock price for a particular company stays flat or goes up over time, then the investor would get full repayment. They would get all their money back. However, if the stock price falls for that company, and again, they're not the borrower, they're just kind of this sidecar. It's the loan is tied to the stock performance of a particular company. If the stock prices fall, then the lender will receive back not their principal amount, not the face value of the bond, but instead they'll receive back shares in the company. And because those shares have gone down, they're typically receiving less than what they lent out to the investment bank. So they've taken a big loss. All right, let's move on to look at bond valuation. Again, with bond valuation, we're simply going to look at 5 possible inputs in a time value of money calculation. In calculators, we have the 5 time value keys. With Excel, you have 5 possible inputs. So the bond value, or the price of the bond, that's simply going to be the PV entry. The required periodic rate of return, that's the yield to maturity. We're going to put that into the I input, the I key on the calculator. The number of periods to maturity is going to be the N input. In Excel, that's called N per, the number of periods. The coupon payments for the bond will give us the payment input, and the face value is simply going to be the amount paid at maturity, so that's the future value of the bond. So the price of the bond, if we're solving for the price, we're simply going to take all the future cash flows from the bond and discount that back at the appropriate discount rate. And by the way, that's what the yield to maturity is. It's the discount rate for a bond. It reflects the risks associated with those cash flows. So let's take a look real quick at Excel and just see a picture of a bond and how those cash flows would work. So if we had, for instance, a 3-year bond with $1,000 face value, semi-annual coupon payments of $20, and an interest rate, a discount rate, or a yield to maturity, all those are synonymous. If we had an interest rate of 6%, we could figure out what the value or the price of that bond is. So first, I have a timeline with periods 0 through 6. I have the cash flows from the bond. We receive $20 after 6 months, $20 6 months later, etc. And then at the end of this 3-year period, so in at the time of the 6th payment, we receive a $20 coupon payment and then $1,000 face value of the bond. So we have a $1,020 cash flow. Now this next row is showing what the present value of each of those cash flows is. So for this cell here, I'm simply taking the cash flow right above it, so cell D7, which is $20, and I'm dividing it by 1 plus the periodic interest rate raised to the number of periods that we're discounting it. So in this case, the periodic interest rate is 3% per period, 3% for every 6 months, and I'm discounting this 1 period. So if I divide that by 1.03 raised to the first power, I get a result of $19 and roughly 42 cents. That's what the present value at time period 0 is of that cash flow. And you can see I just copy that formula across. This is simply the $20 payment in time period 2, getting discounted back 2 periods now. And it's going to be obviously worth less than the cash flow received at time period 1. It's worth $18.85, etc. When we get out to this time period 6 cash flow, we have $1,000 $1,020 cash flow, if we discount that back at 3% per period for 6 periods, the present value is $854.23. If I go down to this cell and add all those cash flows up, add all the discounted cash flows up, I get a result of $945.83. That's what we're in effect doing anytime we figure out the price of a bond. We're simply discounting all the future cash flows from the bond at the appropriate discount rate, with that discount rate being the yield to maturity. Now it's much simpler to simply use these 5 inputs: the present value, future value, number of periods, interest rate, and the payment. And by the way, these are periodic interest rate, periodic payment, to solve for the present value. So I've put my inputs in here. $1,000 is the future value of the bond. It's the face value of the bond, or the par value of the bond, but it's a cash flow that we receive at the future, in the future. There's 6 periods. The periodic interest rate is 3% per period. Again, I told you it was a 6% annual bond, but if we do this per period, we have 3% per period. And the payments are $20. So if I use all those inputs and then use this function here, we solve for the present value with all the possible inputs. We get a price of $945.83. And notice when we solve it in Excel, there's a negative sign in front of that. This in effect is saying that we would have to pay $945.83 in order to receive these future cash flows, the $20 every 6 months for 3 years, and that $1,000 payment at the end of 3 years. In order to get all those cash flows and discounted at 6%, we'd have to pay $945.83. So we're going to stop here and we'll take a look at some more bond math in the next video.
I'm a new soul, I came to this strange world hoping I could learn a bit about how to give and take. But since I came here, felt the joy